Right now, these three stocks are down near 52-week lows. But if you assume that that means they're bad businesses, you could be missing a huge opportunity to make a load of money. You see, guys, if you focus on the numbers and the facts rather than the noise in the media, that's when you get to buy great companies at knockdown prices. So let's take a look at these three and see if there's a great deal or two to be had here. I will say till I'm blue in the face, 52-week lows are a great place to start checking for value opportunities. Now, before you get too excited, let's clear something up. Just because a stock hits its 52-week low or is close to it doesn't make it a buy. The example I always give is I say you could, if your house is worth $500,000, you ask $10 million, and then a year from now drop to $5 million, it doesn't make it a good buy. It's still overpriced. But with stocks, in the short run, there's a voting machine. So the same thing that drove them up unrealistically will drive them down unrealistically. This is like walking into a store and thinking everything on clearance rack is a steal. Sometimes it's just junk, and there's a reason why it's a junk. But when Wall Street overreacts, which it loves to do, and it always does, you can get mispricings in your favor. Stocks will fall out of favor, people will panic, and the headlines will follow the stock price, which means they will scream doom. Remember, the fourth tenet of our principle-driven investing says that in the short run, stocks are a voting machine. In the long run, they are a weighing machine. So in that short run, when a stock has fallen near 52-week low, it could very well just be an emotional reaction from the market that is disconnected from fundamentals. In this video, I'm going to show you the difference of price versus value, how to find the value of companies, and more importantly, what's the price I would pay for each one. Now, guys, with any video that we put out there, I have to tell you, don't take our title literally. The goal here is to sit there and teach a process, and that process is we don't know the future. The future is unknown. We're here to sit there and say, can we find value? Stock number one, guys, this is Mo's favorite apparel to wear. Crocs brand shoes. In the last 1 year, it's down 38%. Year to date, down 21%. Now, what's interesting, guys, in our community, the average community member has this as a buy. And for those of you in our community, pretty soon, you'll be able to put your intrinsic value for the company in here and allow yourself to sit there and say, I think this company's worth this, and everybody will be able to see the entire average of that price. Now, guys, let's be real. Crocs were a joke of the shoe business not too long ago. You saw someone wearing them and thought, really? But here's the thing. Ugly makes money. And Crocs figured that out better than anyone. Today, Crocs isn't just some foam clog company. It's a powerful and profitable machine. They have loyal fans, a pretty strong brand, and a marketing strategy that's basically a masterclass in turning weird into cool. In fact, they've teamed up with everyone from Post Malone to Balenciaga to create a high-end Croc to KFC. Yes, the fried chicken Crocs exist. And guys, they even let you customize your Crocs with little charms called gibbets. I'm a chess player, and I was once at a Crocs store, and they had little chess pieces you could put on Crocs. And they've built a digital presence that speaks directly to younger shoppers, to influencers, and even sneakerheads. That kind of brand strength matters. Now, the core Crocs brand is expected to grow again. It's been going through a little bit of an issue lately, and the company's gross margins are some of the best in the footwear industry. They are even buying back shares and paying down debt. Two moves that tell us that management is focused on shareholder returns. But they do have some challenges. They bought a very popular brand called Hey Dude, and it hasn't lived up to the hype. If you don't know what Hey Dude is, go to a local park or pool and go look at the average 50 to 60-year-old guy. They're probably wearing Hey Dudes. Now, they're trying to turn it around. In late September, Crocs kicked off a new marketing push for its Hey Dude brand, bringing on actress, ready? Sydney Sweeney as the face of the campaign. The same Sydney Sweeney that was working for American Eagle and caused a lot of controversy. It's a clear move to boost awareness and drive sales, especially with younger shoppers. After the Hey Dude acquisition, it hasn't exactly gone as planned, so they're trying to turn that thing around. Now, some investors see strong upside because the core business is humming along. The stock seems cheap compared to its earnings, and the market might be missing the bigger picture. So what's the takeaway? Crocs would be overvalued. But as always, we are going to run the numbers, combine it with the story to put in our stock analyzer tool to find out what price makes the most sense for this company. Because remember, the fifth most important tenet of our principle-driven investing, a great story can become a bad investment if you pay the wrong price, which also means that a great story only becomes a great investment if you pay the right price. So here we are, a $4.8 billion market cap, okay? Cash flow, way higher than net income. You have $770 million in free cash flow last year versus 236. Guys, their 5-year average free cash flow is 630. They're seeing increases in the last year from their 5-year average. High returns on capital, 18 to 20%. What does that mean? It means basically these guys are good at reinvesting the money that's in the business and getting high returns. This is kind of your way of saying, is this a good business or not? It's hard to find really good businesses with low rates of return on capital. I don't remember the last time I found a crappy business that had a very high rate of return on their capital. It's very difficult, okay? So, a couple other things. 59% gross margin. Guys, Lululemon has the same margin. A luxury brand has the same margin, 59%. Now, correct me if I'm wrong, I think Nike is below this number. Now, they took a big hit in profit margin. The 5-year average was 17%. Last year was 6%. So it's something to pay attention to. But guys, look at this. They're selling for 6 times free cash flow. That is insanely low. The market average is 15 to 16. Now, if you're new to this and you're watching this and you're like, what the heck is this guy talking about? You're not alone. At some point, we all said that. The benefit you have is you have YouTube, you have time. You can cut down the learning time significantly by paying attention here. And trust me when I say, I'm going to try to explain things to you as simple as possible. But if you want a shortcut to all of this, I've got a great free PDF that you can download right now. Click the link below. And within 1 or 2 minutes, you'll have the email, the PDF in your inbox. It's a great foundation because I want us all speaking the same language. If we're speaking the same language, you're going to get magnitudes more out of these videos and future videos that you watch. So click that link and download that right away. Remember, guys, I teach on this channel for exactly that reason. I just love teaching. It just happened to blow up significantly to our benefit. Now, 8 pillars, all 8 check marks. Doesn't mean go buy. It means understand the story. First thing I'm going to look at is increased revenue by $3 billion in the last 5 years. Net income only went up $113 million, but look at this. Cash flow jumped up $700 million from this. That's incredible. High returns on capital, buying back shares, debt they can afford, and that low multiple PE ratio for the last 5 years is 8.25. 5-year free cash flow is 7.67. Guys, it's incredible. It's a cheap company. The question is, how long will it be around for? This is why it's important to teach on YouTube. I really want everybody to see that you have to think long-term about things. Now, it could be a short-term play on value, but I like to own companies for the very long period of time. And you got to also remember that most investors, I put that in quotes, will lose money because they try to pick the next winner. The best investors, think Buffett, Munger, Marx, all those guys, they do the opposite. They eliminate the losers first. That's what we're doing here when we analyze a company. We're trying to sit there and say, do they have reasonable debt? Are they selling for a reasonable multiple of cash flow? If we can get rid of the losers out of that, you're going to give yourself just a small pool of really good companies where you're just waiting for the right price. In a couple minutes, we will figure out that correct price. But let's see what analysts have to say about this company. Okay, they're not so optimistic. They see $12 a share this year, falling to $11.60 in the next 2 years on earnings per share. Ironically, with revenue, not a ton, but basically being flat. Okay, so we're going to sit there and assume this flat revenue. But remember, even a company that's declining in profit and declining in revenue still has a value. If that confuses you, let me ask you a question. If I told you there was a company out there that was going to make $1 billion this year, and every year for the next 10 years, that would decrease by $100 million, would you pay $1 for it? Well, of course you would. You get $1 billion back in the first year. Would you pay 10 trillion for it? Well, of course not. It's stupid. So somewhere in the middle, somewhere in those two extremes, there's a price that gets you a really good return on your money. That's what we're trying to figure out here. So let's go to the stock analyzer tool and let's put the story and the numbers together. I'm doing a 10-year analysis on Crocs. Now, I'm assuming here in this analysis that they're going to turn things around in the next 10 years. Okay? But as you see right here, the one thing I like, their returns on capital were increasing over the last 10 years. First off, revenue growth, 0, 3, and 6% a year for the next 10 years. Guys, let's go extreme. Let's say this is a declining business. -3, 0, and 3. Okay. Now, what's their profit margin and free cash flow going to be? I put 14, 17, and 20. Guys, let's be even more conservative. Let's call it 12, 15, 18. I'm trying to beat this thing up. PE. Now, I put in here 10, 12 and a half, 15. That's not exactly fair. What I should do is say, hey, what would I pay for this if this was a growing business? And I'll explain to you why. It has high returns on capital. So I'm going to say 16, 19, and 22. Now, you might sit there and say, but Paul, there's no way it would be that if the company's declining. True. But that's where I want to put that in your desired return. This is where you put your margin of safety. I'm putting 9% or 10% in here to get what's the price according to the market? Not for what price I'm going to pay. That's no margin of safety. We need margin of safety because the future is unknown and we're humans, we're going to make mistakes. But I'm just trying to figure out if this was a normal company, what would I pay? I hit the analyze button. The stock's currently 86, low price of 91, high price of 258, middle price of 156. Now, let's say you're like, Paul, I don't want this company unless it's 15, unless it's 18% returns across the board. So I just put 18 in here, analyze button, and boom. 54 is the low side, 140 is the high side, middle side is 88. Guys, and this middle assumes zero growth in the company for the next 10 years. To me, this needs to be paid attention to because if they just buy back their shares and stay flat as a company, that's a huge compounder. Stock number 2, Sprouts Farmers Market, a company I used to own, got the shares luckily taken away from me at 165. The stock is now down to 106. Now, grocery stores are a low margin business. But guess what? This company is not your typical big box grocery chain. This company focuses on natural and organic food, one of the fastest growing food trends in America. And guess what? It's not a trend anymore. It's becoming the norm, and they're leading the charge. They're leading hard into this shift. They're not trying to be everything to everyone. They're targeting health-conscious consumers who are willing to pay a premium for better quality. Analysts are bullish on this one. Price targets range from 170 to 190, which is a solid jump from where the stock is trading right now. Some are even calling it a strong buy. But let's take those rose-colored glasses off for a second. Sprouts isn't some super high-growth tech company. It's a grocery store. That means growth will be slower than the overall market. But that's not a bad thing if you pay the right price. What matters more is that correct price and whether the business is healthy. And guys, Sprouts is a very healthy business. They're expanding. They currently have 400 or 500 stores. They're adding 35 new stores this year with a lot of room to grow in places like the Northeast, Washington, and even Michigan. This is not a moonshot. It's a stable, cash-generating business in a growing sector with growing margins. We're not here to speculate. We're here to invest. We wait for the right price. The thing I love about Sprouts is their margins in the typical grocery store, 1% to 2%. Guys, they're at almost 6% last year and getting better. Why? They have their own Sprouts brand that's taking up more and more of shelf space. And those are huge margins, way bigger than the 39% they're getting overall. Those margins are 50 to 60%. If they get to the point where 50 or 60% of their business is that, this margin is going to go way higher from 5.77. That's what's important to understand about Sprouts. Now, this stock is on hold here, but the drop this year has been very, very tough. 33% in the last 3 months. My guess is the community members have it a hold because these votes are good for 6 months. My guess is it's a hold from a lot longer ago. Increasing returns on capital, 11% in the last 5 years, 12.5% last year. Enterprise value, their market cap is $10.5 billion. Enterprise value is $12.5. That difference is $2 billion of debt. That includes leases, guys. That's very low for a company with such a big retail space. And free cash flow, growth. $300 million a year for the last 5 years, $500 million last year alone. Growing profit margins. I mean, this is just great. Only 13 million acquisitions. Look at this growth level. 10 years at 10%, 5 years at 6% a year, 6.5% a year. The last 3 years at 10.5% a year. Wonderful. 8 pillars. Okay, 3 X's here. Debt, not worried about it. It's retail. This price to free cash flow, it seems high, but this company has a lot of growth potential. So I wouldn't necessarily, in both revenue and in profit margin. So to me, this might not be high. Yes, it has an X here, but let's say hypothetically, let's go to the other extreme and say they grew profit at 100% a year for 10 years. This would be dirt cheap. That's the key here we want you to remember. That no metric in and of itself means good or bad. It's all in the grand scheme of how you look at things. So what do analysts think? Well, analysts think that their profit's almost going to double from a little over $5 to a little over $9 per share. So about, 80% growth in profit in the next 4 years. And revenue growth, double digits every year for the next 4 years. Incredible. All right, So what's the right price to pay for Sprouts Farmers Market? Let's pull it up in here. 10-year analysis. I did 6, 8, and 10% revenue growth. Profit margin, I went a lot higher. I went 5, 6.5, and 8. Let's do this. Let's call it 5.5, 6.5, and 7.5, because they're basically already at 5.5. PE and price of free cash flow, I put 16, 19, and 22. And again, my 9% desired return for intrinsic value. Hit the analyze button. Guys, I have a low price of 93, high price of 215, middle price of 143. That means paying that 106 price, if the middle assumptions occur, would be a 13% discounted cash flow IRR. That's something to pay attention to. I would definitely take a look at that. Now, before we get to the third stock, I want you to realize my history here. 25, 30 years ago, all I did was chase tips. All I chased was hot stocks, hype, all that stuff. I quickly learned after a lot of losses that that's not investing, that's gambling. And that's exactly why I started to teach. That's exactly what led me to then create Everything Money on YouTube. I wanted to give everybody who was like me 25, 30 years ago, the right tools, the right community, the things I never had but wanted. So when you join Everything Money, you're not just getting these powerful tools, the powerful software. The stock analyzer tool alone is used over 1 million times per year by people in our community. More importantly, you get that community of like-minded people who are all trying to level up their investing minds. It's a very, very serious group of people who want to get better and get smarter. So if you have that mindset, if you want the support along the way, if you realize that it takes a village essentially, come join us. If you're committed to investing the right way, start a 7-day trial. I'm not asking you to make a long-term permanent decision. I'm asking you to make an informed decision. And the only way to do that is to get in the inside. The 7-day trial is a great way to get started. So click the link below. We limit those spots every day. But if you're serious, and I truly mean a serious investor, not someone who just wants to be handed the right stock to buy, I will see you inside the community. Go sign up. Now, stock number 3. This is an interesting one. Copart. Guys, not a sexy stock. No AI, no social media buzz, just salvage cars. But let me tell you, Copart might be one of the quietest beasts in the market. Here's the business in one line. When a car gets wrecked and the insurance company says, yeah, we're done here, Copart steps in, takes the vehicle, and sells it to the highest bidder, either for parts, scrap, or repair. And the kicker? That process is happening more and more because modern cars are loaded with sensors, cameras, and tech. So even a small minor accident can lead to a total loss, which means more cars flowing into Copart's pipeline. More complexity in cars equals more business for Copart. Now this company doesn't just run auctions. It's built a moat, a strong one. They got a massive global buyer base, exclusive relationships with major insurers, and their own proprietary technology that makes the whole thing run smoother than you'd think a junkyard ever could. Now, Copart has very little debt. They print cash. They dominate. So what does that mean? Guys, we don't just buy great businesses. We buy them at the right price. That's the key. That's the thing I will say on repeat for the rest of time in every video. But remember, a great company at the wrong price is still a bad investment. So let's take a look at this company and see what it looks like with the numbers. Year to date, down 21%. It is a $43.5 billion market cap. Guys, enterprise value is lower than that. That means they have more cash than debt. And ironically, our community members have it as a hold. So maybe there's something more to it that I'm not seeing that we'll uncover here shortly. Net income, $1.55 billion versus free cash flow of $1.23. 5-year average, definitely lower on the free cash flow. Have to understand that. It is selling for a premium multiple, 35 times free cash flow. No dividend. Profit margin, guys, look at this. Gross profit of 45%, bottom line of 33%. You know who has 33% bottom line margins? Microsoft. That's incredible. Very little acquisitions, but look at this growth rate. 15% a year for the last 10 years, 16% for the last 5 years, 10% for the last 3 years. Incredible. Incredible. 15% return on capital. And all-time high was just last year, $64 a share. And just a couple days ago, hit $44 a share. Interesting. Okay, 8 pillars. All right. Shares outstanding are up a little bit, not a big amount. Here are these multiples right here. God, look at this debt. Nothing. This company's going to be around for a while. No debt. Let's see what analysts think about the company. Earnings per share growth, 10.5, 13, 13.5, 8.5% earnings per share growth, and revenue growth of 8.5, 10, 26, 4.5, 6. Making this an $8 billion revenue business here in the next few years. All right, so a lot of interesting numbers. The multiples are what bother me. So let's check out what the stock analyzer tool will tell us, because maybe there's something to the fact that it's not exactly, I just did this company back in June. All right, so guys, I did a 10-year analysis. I'm going to do 4, 7, and 10% revenue growth. I did 27, 30, and 33% for profit margin. We're going to change that. We're going to go to 30, 33, and 36. Free cash flow is lower, so I'll go 20, 25, and 30. PE, and price to free cash flow. Now here's the thing, guys. I don't like this declining returns on capital. So I'm going to go a little bit lower. I'm going to go 14, 17, and 20, and again, my 9% return. Hit the analyze button. The stock's currently at 44. This is why it's a hold by our community. Low price of 15 to 20, high price of 45 to 50, middle price of 26 to 35. Guys, earlier this year, I picked 7 stocks, my own Magnificent 7, to go head-to-head against the actual Magnificent 7. I want you to click the video on your screen to see which 7 stocks that I picked and how they stack up. Because guess what? The results are going to surprise you. Thank you for your time.